When is the Fed going to cut rates? Not anytime soon. Welcome back to the Bitcoin Layer. My name is Nick Bhatia, and today I'm going to explain why the Fed is still firmly in tightening mode and is not about to ease anytime soon. I'm going to break down 4 reasons why I believe this is the case. Number 1, let's take a look at a Bloomberg screen called World Interest Rate Probability. So this is something I start my day with every day. I'm looking at what the market believes the Fed funds rate is going to be at each point of time they have an FOMC meeting. These are the Federal Reserve meetings in which they announce their policy decision. So looking here at this screen, you can see that we have the federal funds rate expected to reach about 3.9% in March of 2023. So in the first quarter of next year, we expect this rate to get up to 4% based on these market expectations. And then you see the rate starting to decline in the eyes of the market. This is the market saying that the peak interest rate that the Fed will achieve will be in March, and then they will start cutting rates after that. You can see that the rate is pretty stubborn, above 3.5%, all the way out to the end of 2023, but you can see the rate marginally declining over that time. Now, this means the market sees a Fed pause in March and then gradual cuts after that. So if we are only using the Fed funds rate expectations, we can see that the Fed will be cutting rates by sometime mid next year. Now, this is not the only factor that we have to consider, especially because we know that expectations can certainly be wrong. But what we do know is that the Fed funds futures market is rarely wrong looking out 1 to 2 meetings. And right now, we still have hikes priced in to September and November, and we should be taking the market's word that at least some of these hikes will happen. We can also be fairly certain that cuts are not going to happen at any point this year, based on this curve. Number 2, let's take a look at the Fed's rhetoric of late, especially in Jerome Powell's Jackson Hole speech a couple weeks ago. We hear Jerome Powell saying that the Fed is determined to keep rates in a restrictive territory for an extended period of time. This means that the Fed wants to take rates to a place that slows the economy, slows inflation, and keeps it there for a long time. Now, we know that the Fed is not always correct in their forecasts, especially when it comes to inflation. We heard them claiming that inflation was going to be transitory and was exclusively due to supply chain disruptions caused by the pandemic. We now know that to be false, and we even heard Jerome Powell admitting this in his Jackson Hole speech. But the Fed is very slow to shift its policy away from its rhetoric. So when the Fed started getting into hiking mode at the beginning of 2022, we could assume that the Fed was going to hike rates for several months and several meetings in a row. With that same understanding, we can assume that once the Fed gets to its pause, it will attempt to keep rates there for as long as it can. Let's look back at what happened before the financial crisis of 2008 and how long the Fed kept rates on hold before actually cutting. We see that the Fed raised rates 17 consecutive times from 04 to 06 as it was getting rates into restrictive territory. It then kept rates on hold for over a year before first starting its cuts in September 07. I believe the Fed will keep rates in restrictive territory for as long as it can. Number 3, now what are the factors that we are looking for to see when the Fed might pivot and actually start to get into cuts? It really comes down to financial crisis. So what we see from history is that the Fed is ready to come in and bail out the market with easy monetary policy whenever it sniffs out a problem in the financial plumbing. This includes an array of money market rates, including LIBOR, repo, and other forms of volatility. When we see those metrics spike up in the markets, that's when the Fed comes in and eases. So let's take a look at LIBOR OIS. This is the spread between offshore and onshore dollars. You might be familiar with the Eurodollar system. If you're not, make sure to go check out Layered Money, my book that explains the history of the Eurodollar system and specifically what happened in 2007. So in this chart, what we see is that LIBOR, which is the interest rate on Eurodollars, spiked up tremendously in relation to Fed funds, which is represented by this OIS rate you have on the screen. What you have here is a financial crisis in offshore dollar funding. This happened in 2007 and caused basically a break of the financial system, and it guaranteed the Fed would come in and ease monetary policy in a significant way. Looking at today, we can see that LIBOR OIS isn't really showing any significant signs of stress. We can assume that the Fed will come in and respond if this spread gets out of hand, but right now we don't see anything like that happening. Let's also take a look at high yield CDX. This is a metric that we use in the market to gauge how much money investors are paying to protect their junk bonds against default. So the higher the spread goes, the more expensive insurance gets. We can see that there was a massive spike during COVID, and that was met with Fed easing. We can see a smaller spike this year with the inflation scare, but we don't see this metric going into crisis mode right now. It is something we will be watching closely at the Bitcoin layer. The last thing that we should be watching is quantitative tightening. Now, the Fed is committed to running off its balance sheet. This is a Fed in tightening mode still, because as it makes its balance sheet smaller, this is a net negative for liquidity in the markets. So right now, the Fed is committed to running off its balance sheet, and even after it pauses its rate hikes, it will still be in tightening mode because it will still be engaged in quantitative tightening. This tightening momentum is really hard to reverse immediately, and this is another reason why I don't believe the Fed is going into cuts anytime soon. We will see a pause soon, but it will be keeping rates there for as long as it can. All of this can change if we go into financial crisis. So at the Bitcoin layer, we will be watching all of these market metrics. Definitely go subscribe to our Substack publication at thebitcoinlayer.substack.com. You can find all of our links at thebitcoinlayer.com. Make sure to subscribe to the channel, like this video, and go subscribe on Substack. Thank you to my sponsor, Voltage. Voltage is a great Bitcoin and Lightning Network company that is focused on providing infrastructure for businesses and people that want to spin up Bitcoin and Lightning nodes. Make sure to get Voltage's help setting up your node today.